Welcome to Inside Economics. I'm Mark Sandy, the chief economist of Moody's Analytics, and I'm joined by, per usual, my two co-hosts, Ryan Sweet. Ryan's the director of real-time economics, and Cris. Cris is the deputy chief economist. How are things this week?
Hanging in there.
You always say that, Cris. You're always hanging in there.
You know, it's someday I'll be on one extreme or the other, but today it's hanging in.
Okay, 0 is bad, 10 is good. Where are you this week?
I'd say a nice 6.
A nice 6. Okay, I'm gonna ask that every week and see where he lands.
He's normally probably at a 5, because he's middle of the road.
I know he
right down the middle.
He wanted to say 5, but
he did.
He knew we were going to rib him if he said 5, so he said 6.
Mm-hmm.
Is that am I reading you right, Cris? Am I reading?
Man, I come on here for the therapy. It's
right, and of course the fellow who's chuckling over there is our other colleague, Scott Hoyt. Scott, good to have you on.
Thank you. My pleasure to be here.
This is your first time on Inside Economics.
Yes, it is.
Well, good luck with that. We'll see how that goes. Well, Scott is a consumer expert, an expert on particularly the American consumer. And you've been with us for how long, Scott?
A little over 20 years now.
Is that right? 20 years?
Yeah.
I did not know. I thought somehow it was like 10, but it's not right. Oh my goodness gracious. Who did I hire you? Who hired you?
You did. Yeah.
I did. I hired you. Of course. That was a great hire 20 years ago. And you came from Jcpenney, as I recall.
That's correct.
Does anyone remember Jcpenney?
Of course. Come on.
Really?
There's still a few stores around.
Are there really? I did not know that. Is there?
Yes.
They're still kicking? I thought they went bankrupt for some reason.
Well, they did, but they've come out of it with new ownership, and they do still exist.
I did not know. Any Jcpenney's here in the Philadelphia region?
I'm not sure. There's certainly none particularly close. So I haven't been to one in a long time, but I read about them periodically. I kind of track how they're doing. So they're definitely still around.
So Scott, there was this your boss at Jcpenney. He was a really good economist. I can't remember his name. Who was that?
Ira Silver,
right? You chatted with him at all, or is he?
No, I've lost touch with him.
Yeah, lost touch. Yeah, good guy. Very good guy. But it's good to have you on because we're going to talk about the American consumer. In my mind, the key between continued expansion, growth, and a recession, the firewall, so to speak. So we're going to talk about that in depth. Just as a side point, we were supposed to have Princeton University professor Alan Blinder on. Great guy, done a lot of work with Alan over the years, and he lost his voice or came pretty close to it, and he has a sonorous. That's a word, right? Sonorous.
I don't know. I had to Google that. I was like, this is another Zandy word.
No, but it's a real word.
It's a real word.
Yeah, sonorous. He's got a very sonorous voice, and we wanted the world to hear that, so we postponed till next Friday. And we're very much looking forward to that. I think I might have said this in the past, but there's some economists that no matter what they say, pretty much I disagree with. Ryan's
me
in that camp.
Number one. Yeah.
Only kidding. And there's some economists, almost no matter what they say, I say, yeah, that makes sense. That's right. And Alan Blinder is like, I don't think I've ever heard him say a thing that I disagree with. It's really weird, bizarre. I don't know if he would take comfort in that or not, but it's true. And I can't wait to have him on. It'd be really fun to have a conversation with him. But let's talk about the American consumer, and maybe can I do it this way? Can I hog the mic of course I've been hogging the mic, but can I continue to hog the mic here for just a few minutes, lay out a case, and then turn to each of you guys to, push back, disagree, agree, provide color, flesh it out, all those things. Sound okay?
Can we say no?
Yep.
No, you can't say no. Because I don't have a plan B. You got a plan B?
Okay. All right.
All right, I'll go with your plan B. What's your plan B? Okay, but and of course we're going to do the game, the statistics game, and I think we should spend a little bit more than we typically do on recession probabilities. I'm just getting a little nervous
You should be.
I should
Yeah.
be. But
should
it
be.
depends on the day and the time of day. How I feel about things in recession odds. But yeah, let's talk about that, and I think we need to resurrect. I think maybe it was you, Ryan, who suggested we resurrect some of those statistics we've been looking at back a year ago or so when the podcast started to gauge where we are in the business cycle. That would be helpful. Okay. All right. Here, this is the case. So, my view and the baseline outlook that we continue to hold to, the baseline being the most likely scenario in the middle of distribution of possible outcomes, is a non-recessionary scenario, right? The economy, the U.S. economy, and we're focused on the U.S. economy here, is obviously going to struggle. Already growth is weakening, but it's going to make its way through without going into a full-blown outright economic downturn. There's a number of arguments as to why that's the case, but the argument at the top of the list is the American consumer. And the consumer is the firewall, in my mind, between continued economic growth, albeit weak, and a recession, an outright recession. And the firewall, the consumer, feels like they're in good shape, more or less. I mean, yes, the firewall is on fire. That's the inflation. High inflation is cutting into real incomes, people's purchasing power. And in most times that would be a real problem. 8-9% inflation, would be wage growth 5%. That would be pretty tough to digest. Consumers would be pulling back, but less of a problem in the current context because households, consumers have a lot of extra savings, excess savings, savings they built up during the pandemic, either because if you're on the high income side, you were sheltering in place and not spending a lot of money or as much money as you typically do. You couldn't travel, you couldn't go to ball games, you couldn't go to restaurants, you saved it. And then for lower income households, low middle income households, you have excess saving because of all the government support that was provided during the pandemic. $5 trillion worth, stimulus checks, 3 rounds of stimulus checks, unemployment, expanded, enhanced unemployment insurance, rental assistance, a long list of things. Also, the firewall feels strong, the consumer, because there are a lot of jobs. We're still creating, at least through the month of June, a lot of jobs, and we should come back to that. Unemployment is low, 3.6. Wage growth has not kept up with inflation, but it has accelerated. It's 5-6%. So depending on, and for low wage workers, the lowest wage workers, it actually has kept up with inflation. The wage gains there have been more significant. Leverage is low. Households delevered, reduced their debt loads during the financial crisis and the post-crisis period. Leverage is starting to pick up again. People have been borrowing, but pretty consistent with incomes, and nothing, kind of, if you look at household debt relative to income, it declined after the crisis and now pretty stable. And debt service is very low because, interest rates up until recently have been very low. Consumers have done a good job of locking in the previously low interest rates, record low interest rates, through refinancing waves. So if you're a homeowner, you probably have a mortgage with a 3.5 to 4% mortgage rate, and that's 30-year fixed or 15-year fixed. It's not going to rise. So leverage debt service is low. And yeah, the stock market is down, although I don't know if you guys have noticed, but it's had a good couple of weeks here, come back a bit. But say it's down 20%, but the house prices are up 20%. So the net is consumers are as wealthy today as they were a year ago, and they're a lot wealthier than they were 3 years ago or 5 years ago or 10 years ago. So you add it all up, and it seems to me that it suggests that the consumer is going to hang tough. They're not spending with abandon. They're not going out there and partying hard. In fact, you remember back about a year or two ago, there's a lot of speculation that they would be at this point in time because they have all that excess saving. That doesn't seem like that's what they're doing. They're just doing what they do, spending at a pace that's consistent with a more typical kind of economic environment, kind of the pre-pandemic environment, not too much, not too little, just enough to keep the economy going. Okay. So, and as long as that continues, as long as the consumer hangs tough, that firewall stays up, the economy should continue to navigate through, because the consumer drives the train. They're the biggest part of what goes on in the economy. And if they're doing their thing, we should be okay. By the way, just as a side point, and then I'll stop, get your reaction to all this, is that it feels like the American consumer is driving the train for the entire global economy, right? They're buying everything we produce here in the US and a lot from overseas. The US trade deficit's been gapping out. In fact, the biggest drag on GDP growth in the last, certainly since the beginning of this year, and probably for the entire, since this time last year, is the gapping out of the trade deficit, which goes to the American consumer hanging tough. Obviously, the strong dollar also is contributing to that. But the consumer is the firewall for the U.S. economy, and it's kind of driving the train for the global economy. Very different than was the case during the teeth of the pandemic or back in the financial crisis, when Chinese businesses were kind of driving the train. China has been struggling because of the COVID lockdowns, but the U.S. is kind of leading the way here. Okay, I just laid it out there for you, a long soliloquy, and maybe not a Shakespeare soliloquy, but Zandy soliloquy. And what do you think? And let me turn first to Scott, because he's our guest and the consumer expert. What do you think, Scott?
I think fundamentally I agree with your conclusion, although I'm a little concerned that you may be downplaying some of the risks. And I guess I'll start with your discussion of debt, because I was looking at that recently. And if you look at the trend in the growth in consumer debt prior to the pandemic and look at the level now, we're actually above where that trend would have suggested. Now, debt burdens are very low because the composition of debt has changed a lot. During the pandemic, credit card balances, which are among the highest interest rate debt and out there, plunged, and mortgage debt started taking off, which of course has relatively low required payments because it's lower rate and longer term. So debt burdens are low, but the level of debt is actually, if anything, a bit lower or a bit higher than a trend analysis prior to the pandemic.
Wait a second. So Scott, so you're saying you agree with the conclusion that the American consumer is doing what they need to do to keep the economy moving forward. You agree with that?
Yes,
but
I agree.
You're saying there's a lot of risk to that, and the first thing you go to highlight the risk is debt, the borrowing, the leverage.
Yes. Well, a lot of it ties back to inflation. We're obviously going to spend a lot of time on that because, the inflation is now forcing a big increase in credit card borrowing. And we don't know for sure yet how much of that is transactional and how much of it is actually revolving. But, if we shift the composition of debt back towards consumer debt when the level's already high, then you potentially do run into a rapidly rising debt burden.
Let me turn to Cris, because Cris spends a lot of energy and his time on consumer credit, household credit. Does that ring true to you, Cris? I mean, of all the things I just laid out, the thing I felt most strong and good about was debt and leverage. That was not where I would have gone if I was going to push back on kind of the narrative I laid out. But what do you think? Is that something we should be concerned about, the household leverage and debt?
I think so. I tend to agree with Scott. I think
from
my perspective, and just kind of more generally with your comments, I think it's a bit sanguine in terms of looking at, the aggregate. If you think of the consumer, kind of aggregate consumer, it obscures a lot of things that are going on underneath. And that I think the debt issue is particularly hard felt by the lower income part of the population. So you do see debt rising. You do see bank card usage, up 16% year over year. We have another category in our Equifax credit forecast database called consumer finance, which are unsecured loans. That's up 22%.
Yeah, but that's $100 billion, right?
But that's where a lot of those lower income households are in terms of accessing credit, right? If you have a lower credit score, if you don't have all the ability to access, say, a home equity loan or even a credit card, you go to these other debt sources. So seeing that rise very rapidly, I think, is an indication of the weakness, certainly of that part of the consumer segment.
So you're focusing on, and we have great data here. So the data is fabulous, right? We get data from Credit Bureau Equifax every month, all the credit files in the country. So we know exactly, for the month of June, how much debt is outstanding. Much better than the Fed's data, by the way, which, if you want to get into the weeds, and Cris can do it, our data is saying something different than the Fed data, right? The Fed data has been showing very, very strong increases in consumer credit, revolving credit, and our data shows an increase, but not nearly to the same degree as the Fed data. Is that's correct? Do I have that right?
That's right. You're talking about the G19,
the G19,
the Federal Reserve series. Yeah. I mean, trend-wise, they're both showing increases. Right?
Yeah.
But in terms of the levels, there's some differences there, and I think ours is because we have a little bit more detail. We're going back to the actual source of credit report information. I do think it's more accurate from that perspective.
Let me push way back though.
Yeah.
I'm gonna push really hard back on this.
All right.
So if I add up total revolving credit, revolving is bank card debt, retail card debt, and then I throw in your consumer finance, just for you, I'll throw that in, 100 billion. Is it 100 or maybe it's 200 billion? I can't remember. For context, a listener, the total household debt is $16 trillion, right? So we're talking, very, very.
Yeah, you're throwing in mortgage, home equity.
Yeah.
Right?
The whole shooting match, But okay, but if I take all revolving bank card, retail card, and consumer finance, the level today is only now back to pre-pandemic, right? If you take a look at that chart, it's only, so the level is no higher than it was in early 2020 before the pandemic hit. Here's the second thing.
But it's rising rapidly, right?
Well, okay, but inflation is rising rapidly. So if I'm just buying the same stuff that I was buying a year ago, it's going to be up it's going to be up 9% by definition, right? Because inflation's up 9%. I'm paying 9% more for gasoline, food, rent,
exactly,
airline tickets, that kind of stuff, right?
But incomes are not up 8-9%. Right?
Oh, that's a different story. That's a different story. That's a different story, though.
Well, I think it's germane to the story, right? You're right. If prices were going up, debt should go up at the same rate. No problem, as long as incomes are offsetting that as well.
Yeah.
The disconnect is the problem, right? You do have accelerating inflation. That's going up.
That
rapidly.
goes back to real income shock. It's not leverage per se. It's the fact that my purchasing power is reduced, right? So, I guess okay, they're related. But here's the other thing, and Scott alluded to it. How much of what we're saying is simply I'm borrowing, or simply I'm revolving more? I'm just using my card more. I've got a lot of cash in my bank account from the excess saving, and I feel more, and I'm now spending more on things that would require, or you would generally use for a card. Like if I get on an airplane, I'm going to use my card, right? Because I want those miles on my card.
Yeah. So at the higher end, we do see a credit card debt accelerating there as well, but I'm not as concerned about that population. I think it's for the reasons that you mentioned, right? People are going back to business travel or personal travel. They are using their credit cards more at that end. But the nice thing about our data is that we can break it out by credit score band.
Yeah.
And so we see that not only is the debt rising rapidly in that category, but it's also rising very rapidly at the lower end of the credit score distribution, right? And that I associate with people not so much using the credit card for these other discretionary items, but because of necessities, right? Prices are going up and they have to tap into credit because their incomes are not sufficient.
Here's the other thing I've heard, and it's just anecdotal, and maybe we have data and I'm just not aware of it. The payment rate, that is what percent of the card bill you get every month you pay back, or you pay back. And that's been very, very high. People are paying back on their cards. And at least through the month of May, June, and this is anecdotal, that just talking to people in the industry, those payment rates remain really high, for the folks in the industry, uncomfortably high, because they want people to revolve, right? That's how they make, in a significant way, how they make their money. When they lend you money at a high interest rate, that's where they're making money. So they don't want you to default. They don't want that, but they love for you to revolve amount outstanding so that, you pay interest on it. Is there any data out there? Have you seen any data on that, particular statistic? I don't think it's in our database from Equifax, is it, Scott? Do you know?
I thought it was. I haven't looked at it recently, but I did.
Oh,
I
is
thought
it?
it was in the
Okay.
Equifax database. I mean, I think that was one of the ones that, at least back in the day when I followed it more closely, was perhaps viewed as with a little more suspicion, less reliability than some of the hard numbers. But because they were estimating it, they didn't. Equifax doesn't receive payment data; they have to estimate it. And
Yeah. Oh, yeah.
so,
do you know, Chris? Do you know that? You know that data really well.
It is in there. I haven't looked at it.
You haven't looked at
recently
it
either, but
Yeah, okay.
I will take it. It wouldn't
Yeah, can you
surprise
take a
me
look?
though. It wouldn't
Yeah.
surprise me if now, up till now,
Yeah.
people are, to your point, if you look in aggregate as well, right? People do have savings, right? At the higher end, certainly.
and a lot of it
Okay.
is going to be at the high end. I mean, the folks on this call, for example, we're all probably spending more at the gas pump, and we're paying it all off.
Not me. I'm not
And
driving
so-
at all. I got my leased car. I'm telling you, I got it. I'm telling like 20 months ago. And guess how many miles I have on it? Just guess. Typically, the lease is
20,000.
for 12K a year or something, I believe, right? You can drive up to
Yeah.
12K.
Wait, are
I-
you taking this one up and back from Florida?
I have not. No, this is
Okay.
Oh.
So
yeah.
that changes the calculation right there.
Yeah. But even that, I mean, my other car where I'm racked up a lot of miles on.
So this is your
7,000 miles.
7,000.
7,000. That's
So
it.
this is the daily commute to Wawa to get the coffee and back.
That's it. That's it. Yeah. Or, I might one sundry, I have to get wine, every so often. So do that. What else do? I go to the gym, I go to the gym.
I'm constructing your CPI basket
Right. on the fly.
on the fly.
Just don't add hoagies to it.
So some of us still have kids that we're either taxiing or who are driving themselves all over creation and on our, and then using our credit card when they go to the gas pump. And so I can tell you my transactional balance is up a lot from a year ago, just for that.
What was that whole thing about hoagies? I missed that.
I was just saying not to include that in your basket for the CPI since you are anti-hoagie.
I'm not anti-hoagie. I just can't eat hoagies. I'm very pro hoagie, actually. I just wish I could eat them, but they don't agree with me, unfortunately. Yeah. Anyway, back to leverage and debt. Okay, so you guys are saying that maybe the firewall, the consumer, isn't quite as strong as I think. Oh, here's the other thing on debt I wanted to just throw out. Delinquency rates are low, right? I mean, they're going up, but they're what I consider to be normalizing back to pre-pandemic, because they had fallen dramatically during the pandemic because all the government support, right? All of the forbearance and student loans and mortgages and rental payments and all kinds of things that allowed people to not pay on their debt, and the result is measured delinquency rates, at least from the credit bureaus, because you couldn't report someone on forbearance as being delinquent on the credit file. They're just normalizing. Or am I missing something? Is there something in the data that you're observing that I'm not observing on the delinquency side, which would be a real sign of stress, obviously?
They are low, but they are rising, and I would point out the denominator effect, right? We just said that their
good point.
bank card balances are going up 18-20%. Right, that's going to suppress the delinquency rate. So,
but we can look by vintage. I have not done that. Like what is the delinquency rate on all loans originated, in 2019? Have you been looked at that? Anyone looked at that? That'd be a good thing to take a look at, just to see. But anyway,
yeah, I mean they're low across the. It's not like anything is really screaming at this point, but
yeah,
just something to bear in mind. It could rise. I don't know. Scott,
Ryan,
do you have any?
Oh, sorry. Go ahead, Chris.
Anything to add to that, Scott? I know you look at the data pretty carefully.
Yeah, well, I guess my thing with this, like so much else in the economy today, is can we make the smooth landing, or as the delinquency rates rise, are they just going to blow through equilibrium and turn into a problem that's going to be a threat, say sometime next year? I mean, I wouldn't worry about credit quality this year, but how much room do we have, and can we really level it off and again, it's going to depend to some degree on inflation relative to incomes and how that plays out over the next 12 months. But
yeah,
relatively high, if inflation remains above incomes, then I worry.
no,
I worry
totally.
about the strength of this piece of the firewall over time.
Totally. In my mind, that is the chink in the firewall. I mean, if inflation doesn't come in, if it stays high and real incomes remain under pressure and, low and middle income households run out of that excess saving, then we got a problem. But that's not our baseline, but that is definitely a problem. Yeah. But you put your finger right on it. I think that broadly why my feeling about what's going on ebbs and flows daily, hourly, month, week, minute by minute, because it's, the plane is coming into the tarmac and is it gonna, it's coming in, it's coming slow, growth is slowing as scripted, that's exactly what it's supposed to do, but is it gonna actually land, or is it gonna skid off the runway or crash or what, and that's where we are. And it's and the winds are blowing, the cross currents are blowing here. So it makes it very, very nerve wracking. Hey, Ryan, on this debt issue, anything else you want to add on that?
No, I think we covered it all. I think the key thing is inflation. I mean, it's $493 additional cost for the average household to buy the same basket of goods this year as they did last year. That's an enormous burden, particularly on, Cris pointed out, lower income households. So I think, in aggregate, it looks like everything's okay, but I think with up and down the income distribution, there's some stress points.
Okay, so going back to the frame, there's the consumer, the firewall, the things that are supporting the consumer. We just talked about debt and leverage, and that's the last thing I would have gone to, but that's the first thing Scott went to. But okay, fair enough. The first thing I would have gone to is what you just did, and that's real incomes, the high inflation rate.
Yep.
So if inflation stays at 9 on CPI and wage growth stays at 5, and that's where it feels like it roughly is in aggregate, that's -4 real income. You can only do that for so long. We're fortunate that households, including low income households, have a lot of excess saving built up during the pandemic. So they seem to be supplementing the hit to their real purchasing power by drawing down on their savings. And that you can kind of see it in the data in terms of saving rates. But you can only do that for so long. And so this feels like the most serious thing. But on that front, so let's talk about that for a second, because I think that's key. That goes to the rate of inflation. You have this great chart that decomposes, or great data that decomposes. Actually, I will say Cris improved on your
He did.
chart. He did.
That was a good point to add rents.
Yeah. Now I stole Chris's chart and I tweeted it. Did you guys notice this? You didn't find my Twitter feed? No.
I'm having Twitter problems. So
you're having Twitter problems? What do you mean?
I can't get in. I can't post. No.
Oh, you got.
I apologize to everyone who's tweeting. I can't actually respond.
Oh, that's right.
IT issues here.
He's all over your Twitter feed. I've noticed.
Now my work is doubled. I got to keep up with both of you on Twitter.
I know. It's crazy. This whole Twitter thing. But where was I? Oh, so the decomposition of inflation, and take the 9% CPI inflation through June. Actually, just to be precise, everybody, 9.1. But let's just say it's 9 to round. Of that, 5 percentage points roughly is energy, right? And then you got another percentage point or so that's food, which is also mostly energy because of diesel prices. Right. Then you got another 1.5 percentage points due to supply chain disruptions that still are creating havoc in some industries like the vehicle industry and high vehicle prices. You net all that out, you're down to 2.5%, and that's the Fed's target, 2.5%. So if energy prices simply go flat, they don't even have to decline, they go flat. And food prices go flat, which seems more than likely if energy prices do. And the supply chain disruption, I know there's a lot of ifs, but just go with me. I can see everyone. It's like a volcano ready to burst. The supply chain issues continue to improve, and they've been improving.
They are.
Then we go to 2.5, right? No, I mean that's okay, so that's the baseline forecast. What do you think of that? And obviously the risks around it. Cris, let's go back to you because you're the one who's most I think it seems like you're the most skeptical of that outlook.
We will get back to 2.5. I'm not doubting that. It's just a question of timing and how, right? So
Right.
Those are a lot of ifs, and I think there are other ifs that are not included there, right? You're assuming everything moves in that one direction, but another disruption, ECB hikes 50 basis points, right? There are lots of things going on here that can impact the outlook.
Yeah, is that consistent with high rent inflation? Because I mean, rental price inflation tends to be persistent, and house price growth hasn't come in yet. I mean, I'm sure it's going to, but it hasn't yet. So, it needs to come in, and then that's going to take some time before it feeds through to rents. So, rental price inflation is going to stay high for a while.
Mm-hmm.
And doesn't that, can you really get to 2.5 if you've got, rent price inflation at, I don't know what, 4 or higher?
5, it's 5.5, isn't it?
Okay, 5.
Yeah. Well, yes, that's a good point. So rent inflation is CPI of shelter, which is tied to rent growth, has been accelerating and adding more and more to inflation, going back to the low vacancy rates across the housing stock, the severe shortage of homes. But I'm in that decomposition I just did, that's through June, and it includes the contribution of higher rent inflation to CPI. So I'm assuming that remains the same going forward, about the same. And it probably will rise a little bit more before it comes back in. But my guess is by 2024, it'll start coming back in and be pretty consistent with where it is today. Still contributing a lot to inflation, but still consistent with 2.5%. And by the way, 2.5%, that's kind of the high end of what I consider to be the Fed's target. They never said 2.5. They say 2, which is the core consumer expenditure deflator. But given the CPI is mostly around housing, it's much higher weights on housing and other measurement issues. 2.5 seems to be the high end of the range. That's kind of my take on things. But just so I am counting for the higher rent inflation. But Cris, back to you.
Yeah.
Okay, you're right. I mean, there's all kinds of risks to what I just said about where inflation is headed. But those are risks, right? You can't forecast those things, right? You can't. I guess you can forecast there's something that for some period of time, there's something else is going to go wrong by definition, almost by just probability draws, you're going to get that. And therefore you're going to get something along the way. And therefore we're not going to get inflation coming in as fast as we think.
Yeah. I don't know where the next disruption in the oil market is going to be, which specific country, which specific area, but pretty good chance there's going to be one in the next 6-12 months.
Just takes a hurricane.
Well,
I was just thinking that you get a big hurricane in the Gulf that disrupts production for a while. And I think they're forecasting an active season.
Mm-hmm.
Yeah. Okay. All right. Fair enough. But so that's an interesting problem as a forecaster, though, right? Because your baseline can't include, or could it, or should it?
It should, right?
How? I mean, because you don't even know what it is. If it's one thing, if it's a hurricane that wipes out a refinery on the Texas coast, it's another thing if the EU decides to actually implement its sanctions on oil. It's another thing if the Russians stop shipping natural gas or stop ag shipments coming out of Ukraine and Russia. So how do you account for that?
Well, implicit in your oil price forecast, you're making some assumptions about those other. You can keep the forecast for oil prices higher than what you would otherwise expect, assuming that there will be some other. You attach some high probabilities to one of these other events.
Well, we're basically doing that though, right? Because we're at $100 oil, and that embeds market expectations for all the risks you just articulated, right? So presumably, maybe it doesn't capture it fully, but presumably they attach some. Traders are attaching some probability to all of those different scenarios, right?
That's right.
So,
that's right.
Yeah.
I guess I'm attaching an even higher probability than they are.
Yeah. All right. Okay. I mean, that to me, you're right. That is the biggest potential chink in the firewall, and that is, inflation remains higher for longer. Yeah. because if that's the case, then we blow through that excess saving, and consumers have to pull back, and the firewall comes down. All right. Okay, so we talked about leverage and debt. We talked about real income purchasing power inflation. What about, or Ryan, I'll turn to you next. What do you brought up the real income. I should turn to Cris next. Cris, what would you point to? Well, of all those things I just said, in my rank ordering, the least thing I'm worried about is leverage. The most thing I'm worried about is inflation. What about you? Or did I even miss something that you would point out when thinking about the consumer and how consumers going to spend going forward?
I think it's a question of timing, right? In terms of the most immediate threat, I would agree with you. If inflation remains high, real wages are low or negative, right? Consumers are going to pull back in the short term immediately, right? But I think Scott is thinking 3 steps ahead of us here with the debt, saying, even if we get through this patch here, we on the other end of this, as we get into early 2023, we may still have a debt issue, right? If consumers are piling up all this variable rate debt, interest rates are rising, that's going to put even more pressure on their balance sheets later on. So I think both matter. I think it's a question of what's your time horizon, what you're most focused on.
Oh, interesting. So your inflation and leverage would be kind of at the top of your list of concerns, but depending on your horizon, your timing.
That's right. That's right.
Inflation most immediately, and then if you look out a year or two, leverage becomes more of an issue if current trends continue.
Correct. Right. Because it takes time for those. If you're talking about leverage in terms of the problem, right? You can put on some additional debt now. You can keep making your payments for a while, but when it becomes an issue, will be later on when things slow down, perhaps, and when the rates are continuing to rise. That's when the debt burden will become more acute.
And when you've blown through your excess savings.
Exactly.
Which at the low end particularly probably isn't going to take that long.
Well, I don't know about that. So let's turn to excess saving. I mean, we do our, obviously it's hard to estimate, right? But we do our calculation. You do them, Scott, right? You and Matt Walsh do these estimates based on the survey of consumer finance and the financial accounts, the Fed data. And we, it's lagged because the data here is lagged. We have data through the first quarter of 2022. So let's say March, because I think it's month ending data. So it's a little bit lagged. But when you look at that data, it gives you the sense that people have a lot of excess saving across the income distribution. Even those folks in the bottom part of the distribution, I think the bottom quintile, we estimated excess saving at about $5,000. So if just take that group, which is it's a little bit weird to look at that group because I don't know that there's a lot of things going on there, retirees and students and other stuff. So let's just use that group, 5K. If, Ryan's calculation is that, the higher inflation is costing the typical household $500 more a month to buy the same goods and services as they were a year ago. That's probably on the high end for those folks in the bottom quintile, but let's just go with it. That gives them 10 months of, cushion until hopefully inflation comes in, and then they start to have a real problem. If you do, that's, by the way, guys, that's what economists or listeners, that's what economists call a back of the envelope calculation. But would you concur with that kind of analysis or anything to say about that on the excess savings side? And by the way, just to round it out, for the typical American household, so kind of in the middle of the distribution of income, excess saving is probably closer to, 7,500, 8,000. And for folks at the high end, it's like crazy high. It's like the top quintile is like 100K in excess savings. So a lot of savings. But is that the way I characterize things on the excess saving consistent with the way you think about it, Scott?
Yeah, I think that's fair. I guess my concern, though, is that, your 10-month number is on average. You're going to have an increasing share of consumers that have used it up as time passes. And when you get to that average number, you've probably got something on the order of half or maybe even a little more, because we know distributions tend to be skewed. So, you're starting to see folks in trouble, well before that. And I also, while I think our excess savings estimates are good. I do worry about some of the underlying assumptions, and I wonder if we may not be, overestimating how much the low income folks have, because, a lot of our assumptions are that, shares that were in place in 2019 have been maintained, and, nothing much was maintained in 2020 from 2019. So,
although we know the aggregate, we're pretty well.
We're pretty comfortable. Well,
even there, maybe.
Yeah, because given the magnitude of revisions to savings,
but generally saving gets revised up, not down. But regardless, we're at 2.5 trillion in overall excess saving.
Yeah,
that's a lot of excess saving.
No, I agree. I think that's a huge buffer, and I think that's why I said at the start, I think the risks may be higher than what you portrayed in your opening monologue, but I agree with your forecast, because
soliloquy,
I do think,
Scott, not monologue.
I'm sorry, soliloquy. Forgive me.
Please.
But I mean, that's why I agree.
Some respect, please.
I do think consumers.
A modicum of respect. I don't get it from my two co-hosts, but I guess, please.
My quibble is more whether you're underplaying the risks than with the baseline. Because I agree with the baseline. I think there's a lot of excess savings out there, and I think that will, under baseline assumptions, that will cushion us through. So I'm not challenging the baseline. I'm just questioning whether you're underplaying the risks.
Got it. And Cris, you did you looked at the which is goes back to this question about how much excess saving is available for low income households, particularly the bottom quintile.
Yeah.
You looked at the distributional financial accounts. You want to explain that analysis? Because I thought that was pretty cool.
Yeah. So it's a bit of a narrower definition that I use, and it paints a different picture here. So the Federal Reserve does put out a data set of distributional accounts where they go through. They have a process for taking their income product data, the national accounts, and distributing them across different deciles of income, of wealth, by age cohort, by race, right? So there are a number of different cuts that they provide. If you look at the income distribution, and I focus just on the liquid assets, so look at checkable deposits and currencies. How much cash on hand do people actually have in their accounts? If you look at that series and you break it out by income, you actually see that the bottom 20% of households have less cash on hand than they did prior to the pandemic. So that's where I come up with the conclusion that that group is really suffering much more than what you see at the other end of the distribution. And it also explains why they would be going out and getting more credit, right? Accessing more credit to supplement incomes, because they don't have the buffer that the other groups do.
Yeah, and that was a really cool analysis, because you're just looking at things that deposit accounts, as you say, and you can measure that, right? The banks report that, and the Fed brings that into the data.
Yeah, it's hard data.
Hard, quote unquote, hard data. But across all the other income groups, the top 80% or quintile, 80% of the distribution, the amount of cash sitting in those accounts is higher, much higher, much higher.
Especially
really
the top
that bottom
10%.
20% is what you're saying. It's actually lower than it did rise, because you looked at it a year ago and it was higher a year ago, and it has come in over the past year for that bottom quintile.
That's right.
So that's different than what we or Scott and Matt figured out using the other methodology. That, of course, you're looking at liquid accounts.
Exactly. So that's there are other.
Yeah, they could pay down debt. They could have paid down debt. They could have, who knows, but nonetheless, so they're not necessarily inconsistent.
Correct.
We just don't know. But that's a good point. The other thing I'd point out in this regard, because we're focused on the income distribution, and I agree, I do think low income households are, got to be under pressure here, right? Particularly if you're not working, if you're got fair folks that have been pushed out of the workforce because of the pandemic and other things, you're really having a hard time here, no doubt about it. And this sounds a little cold-hearted, but the vast majority of the spending that's done is done in the top part of the distribution of income. I think the top, correct me if I'm wrong, Scott, and this is kind of a heuristic, a rule of thumb, the top third of the income distribution accounts for almost 3/4 of the spending, I believe, something
Yeah,
like
I think I had 2/3 in my head, but
2/3,
yeah, it's
okay.
definitely something. I haven't checked that number in a few months, but yeah, it's definitely something like that. It's very disproportionate. But I guess that brings up another issue that I've been wondering about, and that's well, I'll probably tie two things together. One is the stock market, and the other is confidence. Because we know the confidence has come down, the stock market has come down, and especially, I mean, I was just looking at your forecast for the stock market, and you do have it rebounding at least a little bit going forward now, because
it's basically flat though, Scott. I wouldn't characterize it. It's basically we're down to 4,000 on the S&P, which by the way is where we are today, and it basically goes sideways here for a while until the Fed stops raising interest rates.
Okay. But if that's the case, if the stock market goes sideways for a while, and then stock market gains go further and further into the past for high income consumers, does that, especially in an environment where confidence is falling, and it's falling, I mean, yeah, probably more at the low end, but across the income distribution, do we have to worry about the high-end consumers continuing to draw down their excess savings and spend, as opposed to saying, okay, the rest of my excess savings is my retirement savings or my kids' college savings or some other long-term savings that I may not have done enough of prior to the pandemic, and I'm going to tighten my belt and, pull things in a bit. And, again, that's probably not my baseline forecast, but I worry about it.
Yeah, you're a worrier. I can tell. Yeah. Well, that makes a lot of sense. There's two things. One, if you go back to Chris's data on what's sitting in deposit accounts, it's shocking how much cash is sitting in those deposit accounts. And it's not like it's gone into another asset, right? A home, or it probably has done that too for the high income households because they've had so much cash, but they got a lot of cash sitting in the bank account. And my guess is if you get into a scrape or, your income is impaired, you will draw that down pretty quickly because you don't need to sell an asset. You don't need to sell stock. You don't need to sell a home. You don't need to borrow money. You got the cash sitting right there that you're
right. But I guess my feeling is that spending by high income groups is never a question of access to cash.
Right.
They always have that. It's a question of confidence and desire to spend relative to concerns about future needs.
Yeah, but even high income households get cautious, right? I mean, it's not like they don't get cautious. And I just said, right, just wonder. If you look at your bank account, you got so much cash sitting there, but it's less likely you're going to turn cautious.
Unless you're putting that cash into a different bucket. If you're saying, yes, I have this cash, but I consider this cash my retirement savings, and the only reason it's in cash is because I'm scared the market's going to go down more and interest rates are going to go up more, and I don't know where the heck to invest it. So I'm going to leave it in cash until I figure out where to invest it. But I don't consider that part of my cash. I consider that part of my retirement fund.
Yeah. Is that how you think about things?
That is to a fair degree how I think about things. Okay. Yes, I do bucket money. I do tend to bucket money like that.
Even in your checking account, you're bucketing that money.
Well, I tend to have a separate checking account for each bucket, but
okay.
And it won't be a checking account. It'll be an online savings account, so I get at least an epsilon of interest, but a tiny bit of interest. But
after 20 years of working with you, that sounds like Scott would do that.
Yes.
Right.
Mm-hmm.
Yeah. Smart. That's actually smart. Very smart. But you brought up, and we should explore, and maybe I'll turn to you, Ryan, is consumer sentiment. I didn't bring that up in my frame. I was kind of going to the fundamentals, but people are really down, pessimistic, blue. Maybe you can think of a few more words to describe how they feel, but it's pretty bad. miasma. Oh, there's a good
Oh,
word.
that's
a great one.
There's a
Mhm.
miasma hanging over consumers. How do you think about that? I mean, in the context of their spending, and the firewall feels like it's pretty strong, but you got pervading all of that this pessimism. What do you think about that? How do you think about that in the context of consumers hanging tough?
So I'm less worried about sentiment because the relationship between consumer spending and sentiment is pretty loose in the short run. So, people can say one thing, but they do another. And also it depends on what measure of confidence you're looking at. So the Conference Board Consumer Confidence Index, which is very sensitive to labor market conditions, is holding up relatively well. Like it's not as depressed as the University of Michigan survey. And that's the one that gets all the headlines in the press. And that one's sensitive to the stock market and gasoline prices. So, last month, gasoline prices peaked, stock market was tanking, and it fell to the University of Michigan survey, fell to a historical low. So that's not too surprising, but in the end, in the short run, people can say one thing and do another. So that's what I prefer to watch what they do rather than what they say.
Yeah, I got a theory for you guys. I'm curious what you think of it. My sense of it is that if consumer sentiment was more typical, it is bad. It is really bad. I mean, Conference Board survey better than the University of Michigan survey, but it's still pretty low.
Yeah.
That if it was more typical, that consumer spending actually would be the counterfactual would be a lot stronger consumer spending. People would be spending more aggressively, but because sentiment has been so low, they've only been spending at a more typical pace, exactly what they would have spent without the pandemic. I mean, I could take real consumer spending pre-pandemic up through this current time, draw a trend line through the spending before the pandemic, and consumer spending today is exactly where that trend line is today. Does that make sense what I just said? Yeah.
Yes.
So they're spending, it went down obviously during the pandemic, it's come back up, and it's like exactly where you'd expect it to be, which is weird given all the other things going on here. The excess saving we just talked about, a lot of jobs, low unemployment, leverage is low. It's starting to rise, but it's low. People are wealthy. You would expect a lot more spending. And that goes back to all the concerns about, demand side inflation, that inflation is being driven by demand. And people were concerned that it was because the consumer had all this extra cash that they were going to spend, but they haven't done that. They have not done that. And maybe that's because of this low sentiment. So what do you think? Does that make any sense to anybody, that theory? I
would push back. I would disagree.
You would disagree.
When you model like real consumer spending, and you just, you can look at leverage, real disposable income, include different measures of consumer confidence. Sentiment explains very little of the near-term fluctuations in spending. It's real disposable income that drives the train.
No, I totally agree. You just estimated an equation over some lengthy period of time. And I would argue that there are periods of time.
Oh, I see what you're saying.
When that matters a lot, particularly around recessions but in
inflection
the
points,
environment,
right?
Maybe, I agree with you. Typically, sentiment reflects the economy. It doesn't drive the economy. It doesn't drive consumer spending. But there are times when that's not true. The causality shifts. And maybe that's something, that's kind of sort of what's going on here. It matters, but the counterfactual is we would have a lot stronger spending if not for the very weak sentiment that exists.
But I guess the concern then is that sentiment, it appears to be still declining, especially the Conference Board measure. I mean, maybe Michigan ought to be bottoming out just because it's.
I think it bottomed out. Well,
it went up
it ticked up.
trivial amount in the last reading. But I mean, if you do something like the average between the two or something like that to get something that's a little more blended and sensible, then the trend is down. And so, if confidence, if that trend remains in place, then don't you have to worry? If you are arguing that it's mattering, then you have to worry about that impact growing.
Oh yeah, I mean I do, but fortunately, gas prices are down. And Ryan's right; that has a big impact on sentiment. Stock prices are up; that has an impact on sentiment. And that's why the
But
University of Michigan probably will improve relative to the conference board, because the job market is definitely good. So, by the way, we should go to the job market. No one brought up the job market. Are we all assuming that?
Oh, I was waiting for the stats game because that's
we're going to
come
wait for
up.
the stats game on the job market. Okay.
But one thing with sentiment, they break it up usually into consumers' assessment of present conditions and expectations, and the expectations continue to deteriorate, and that's pulling down leading indicators, and then that's a little cause for concern.
Yeah, no. Yeah, I mean, at some point, actually, just throw it out there. And hopefully I don't take anyone's statistic, but one of the best leading indicators of recession is the change in the conference board survey of consumer sentiment. If that falls by more than 20 points, it's an index. So if it falls more than 20 points in a 3-month period, we always have recession, and it's never falsely predicted recession. And that, the intuition is clear that, again, back to the causality, at some points in time, particularly around recessions, causality shifts and sentiment drives spending decisions in the economy. People run for the bunker, so to speak, and stop spending because they're panicked by whatever is going on. And the conference board survey is down about 10 points over the last 3 months. So I'm watching that pretty carefully, as the job market is going to weaken here, right? By definition, it's going to weaken.
But just to add to that, Mark, it's down all 10 points over the last 2 months.
Well, I thought it was over what is it over the last 3? I thought it was 10.
But 2 or 3 months ago, we're about the same level.
Oh, I see what you're saying. I get one more really bad month, I could be down 20 is what you're saying.
Yes.
Yeah.
You get a 10-point drop in the next month and you're down 20.
Yeah. And that leads recessions, by the way, just a point of interest, by I think 4, 5, 6 months, something like that. So anyway, all right.
Chris, I have a feeling his probability of recession moved up.
You would think.
He's got to
be consistent
himself higher.
It has moved up. Yes, it has. Yeah. Do you view that as a victory, by the way?
No, I do not want a recession. But
But he also wants to be right.
I also want to be right.
Also want to be right. Yeah. Okay, let's play the game. Unless there's anything else, there's a gazillion things we can talk about the consumer, but I think we've been at this almost an hour. We got the game, and we got to talk about probabilities of recession. So anything else on the consumer, Scott, I missed, or Chris, Ryan, that no?
I think we got it.
We covered a lot of ground. We didn't talk about, we kind of indirectly talked about wealth. We didn't talk about house prices, but we'll save that for another day. Maybe that's part of the statistics game that's coming up. Could be because a lot of housing statistics came out this past week. Okay, the game. Statistics game. I know you guys get annoyed when I repeat the rules of the game, but we have to do this because Ryan cheats. I know he cheats. You got to tell him, how this game is played. And that is, you want a statistic that's not too easy so that we all get it all at once, not too hard that, forget about it. Of course, we all come up with the statistics, and each of us try to figure that out through deductive reasoning, questions, and clues, that kind of thing. And you want a statistic, if you can, that's topical, recent, last week or two, topical, which would be the consumer. Okay, that's the game. All right.
Chris, you catch on to that? He changes the rules every time.
Last week or two.
Last week or two?
Yeah.
It's always been the last week. See, he's ill prepared. He's ill prepared.
No, actually, he's bailing me out because I've been on vacation most of this week.
Oh, okay.
And so, and I wanted a consumer related statistic. So the one I have in my hip pocket actually is from 2 weeks back.
Well,
so
you're the guest.
Too much information. Way too much information.
Yeah, you just gave it away.
Yeah.
Well,
what the hell?
maybe.
By the way,
I thought I should
way
tell
too much credit. That has nothing to do with you.
You didn't know that, but you are bailing me out.
That's so funny. Okay. All right. Who wants to go first?
Well, let's go. Let Scott go first.
Okay, Scott,
since
you go first.
We know 2 weeks ago.
Yep. 2 weeks ago, I have two numbers which are from different releases, but I think should be tied together. It's 8.4% and 13.4%.
Consumer related.
Is one from
for a mortgage balance increase over the last year?
No.
Ooh. Is one
I think it's close
universal?
to that, though. I think it's close to that.
Yeah, no, I think it is. Yeah,
Might
maybe
be,
it's
but
stronger actually. 13.4 would be more like mortgage debt growth, I think.
Over the last year?
Okay, I'll bet you.
No.
I'll bet you on that. Side bet.
Side bet. Dollar bet. There we
Ben,
go.
write it down.
Above 10, below 10%. Bet.
Year over year, mortgage debt outstanding.
Yes. Yeah, through the month of June. I bet it's over 10. Anyway,
All right.
back to the main show.
Is this related to buying plans in the University of Michigan survey?
No,
Okay.
It's consumer related? Is it related to jobs in any way?
no,
Is it related to spending, retail spending?
yes,
Oh,
Okay. Are we
Oh.
looking at growth in specific categories of spending?
no.
Oh,
Oh,
that'd have been too easy.
is this a calculation you got to do? Is it like above or below pre-pandemic? Okay.
Both numbers are year-over-year growth rates.
And they both come from different reports.
Yes,
Is one and they're both positive, you said 8.4 and 13.
and 13.4. Yes, they're both positive.
Yeah.
No,
I
I'm
was
not
gonna
falling into Marissa's trap.
Right, the negative sign, because I was going to say like Walmart sales or something, but well, it could be. Is it a retailer's sales growth?
No.
Oh, geez.
gee.
Oh man. Let me ask you this: are we being idiots? Should we know this?
Do we have a
The
chance?
8.4, I am very surprised you don't know. The 13.4 is a little more subtle, and that one I would not. That one's hard.
Oh, I see. Okay.
Well, All right. This is just a guess. 8.4, is that just total retail sales year over year?
Yes.
All right.
Oh.
I think we're overthinking it.
Oh, we were overthinking it. We were
So
overthinking it.
13.4 comes from something different. It's not
Yes.
retail
It's
sales.
from a different
Not retail.
report. Oh,
Yes.
okay. Oh, you were being a little sheepish because you thought that couldn't be the answer.
Yeah.
Right.
Yeah.
Yeah.
Oh, that's so funny. And so what's the 13.4? Is that I'm gonna just a corollary, is that services spending growth?
Nope. We wouldn't
Okay.
have that yet, actually,
Yeah,
because I'm looking
Maybe
at
then
June.
next week.
is it next week? Okay.
No,
But it's
Is this-
spending. It's growth in some form of spending.
no,
Oh,
No.
it's not.
Is this something from Michigan?
Oh,
no.
No.
a lot of no's coming out of that. Jeez Louise. All right, I don't know. What do you guys give up? You want to hear it? Because he said it is subtle. I think he used the word subtle. Yeah.
Are we
Yeah.
going?
It's not a
Oh,
high
hold on.
profile. It's not a high profile
going
number from the release.
I don't even
It's
know
not
if
something
still-
like, I don't
Red
even,
Book?
I was going to say Red Book. Can't
Yeah.
be Red Book.
No, because it's not a spending number.
It's not like a Visa.
Okay, it's a price
JP
number.
Morgan, huh?
Price.
It's a
Price.
price number.
Everything's up 13.4.
13.
But I'm tying the two. But I
give
tie
up.
the two together.
Is that retail, the inflation for
Nope.
retail goods?
We don't have that yet.
Ah,
And what came out last week? What you
CPI.
guys talked about last
CPI.
week?
CPI,
CPI.
Yeah.
So what component of the CPI would I be looking at?
some kind of retail goods CPI.
Commodities CPI.
Oh, okay. All right. Fair enough.
All
fair
right.
enough. That's
So
not-
and the point I want to make is that spending.
You have a point?
is- I
You
do.
don't have points in this game.
Spending
No.
was up 8.4%.
Uh-huh.
Prices
Oh, yeah.
for a
Up there, yeah.
roughly
Good point.
comparable basket of goods is up 13.4%. What does that say about real spending
Yeah, that's a good
on
point.
goods?
Yep.
But I got pretty close when I said inflation for retail goods, right? I mean, come on.
You're in the
Yeah.
ballpark.
Oh, that's rude. That's rude. But no, that's a great point.
Mhm.
So even though retail sales I think it was up 1% in the
Yep.
month, nominal, so includes inflation. You're saying real after inflation, it was down, negative.
Yeah.
But and people took solace in the 1%. I mean, markets did because it was stronger than anticipated. But it
Right.
was, yeah.
But the trend in real, now obviously a lot of it is energy. I mean, if
Yeah,
you do the same, if you
energy.
do the same thing for core, the gap between the two is less than half a percentage point.
Oh, okay. So okay, that's good to know. Yeah.
So it's food and energy, but it's still taking a bite out of consumers'
Yeah.
budgets, because the point I always make is that, while economists care about core, consumers buy food and energy every week, and that's what they care about a lot. So it really matters to consumers.
Yeah, no, that's good. That was a good statistic. Okay, we better move forward. Ryan, you want to go next?
Minus 18.6.
Minus 18 point.
Came out this week.
Not this week.
It did come out this week.
It did.
Is it? It's not housing related.
not?
It could be. Everything's down in housing. Is it from the Philly Fed survey?
It is.
I knew it.
Close to our home.
It's one component of the Philly Fed survey, because the
is.
Philly Fed survey is down like -12 or something.
Mhm.
So it's not
This is
that.
This is the lowest since 1979.
And that survey's been done since 1968, I believe. Yeah.
Yeah, give or take. Yeah,
Yeah. So a long
Yeah.
time.
it's a long time.
By
A
the
long
way,
track
on the
record.
Philly Fed, it used to be when I was a young economist that was the foolproof leading indicator of recession, because Philly Fed is manufacturing activity in the third district of the Fed system, which is Philly. It's small, but it was a very good leading barometer, and you had this long time series. And I think to this day, it's still excellent at, I think it has to fall more than to -20 though, for it to be a strong signal of
The
recession.
headline. Yep.
The headline, yeah.
Mhm.
Okay, so what's down 18 is one of the components. Is it orders? It can't be orders.
New orders, yeah.
No,
Mm-mm.
no, it's too much. I know prices received, prices paid still got to be high, but they're coming in.
Correct.
Supplier deliveries, they're coming in, but they're still high, I think. Employment, no, can't be employment.
You guys you're getting really close. You're just dancing around it.
Yeah, what else is in that survey that I'm missing there? What other components are investment somehow? Investment spending? No.
I wouldn't think component.
Inventories, office space use. That's not it.
Remember the general business conditions index is
Yeah.
its own question. It's a measure of business
exactly.
confidence. You're right. So
Yeah.
when you're thinking component, there's something else they ask that's the lowest since 1979, and it gets back to recessions.
Expectations.
Mhm.
It's a
In the next 6
Oh
months.
yeah, it should have known that. Right.
Good job. Yeah.
Yeah, expectations. They're down. Yeah. Like
The
everything, like all these surveys, right?
Yeah, it's really bad. I mean, look at the NAHB that fell a lot this week.
Yep.
Across the board, confidence, small business confidence, our weekly business confidence survey, everything is just down in the dumps.
Yeah, but a lot of, sentiment is down, right?
Yeah.
There's a lot of sentiment built into these kind of surveys, these diffusion indices, don't you think? It's generally,
No,
the
yeah.
question is, are we going up? Are we going down? Are we staying the same? Right?
Correct. Yeah.
And-
Specifically the regional Fed manufacturing survey.
Yeah.
The ISM, you can break out the ISM into like the hard ISM component. So you can, look at the details of the ISM and map it to like the hard manufacturing data and then back out the sentiment component. But yeah, the regional, Philly, New York, Richmond, all these are driven by sentiment.
Yeah. I think the Philly Fed, again, was the first survey done, first
Mhm.
one done. And it really, when I back 30 years ago, that was like a really key indicator. People really paid a lot of attention to it, much less so now. All right, we're going to do one more because we're going to move on. Let's go. Cris, what's your statistic for the week?
All right. Two for 824,000 and
I know it.
840. Yeah.
Stop. It's
What's the second one?
You
have to give me the
don't
other
even tell a
number.
second. Wait a second. Okay. 824,000 is the single family homes under construction. Okay. Ryan, are you
Collusion.
taking this in? Are you taking this in? And then I'm going to tell you what his
collusion.
next question was going to be. 868,000.
No.
No? Okay.
841,000.
Huh?
841,000.
Oh, 840. That's multifamily.
Yeah.
Oh, okay. Look,
That's impressive.
Scott, that's how it's done. It's done. That's
Right.
like, what was that movie with Tom Cruise where he could predict the future? The guy who's good. It was Minority Report.
Yeah.
That was like Minority Report. They should put like little electrodes on my brain, because I could predict.
And you could swim in a vat all day.
I can swim in that.
I didn't hear the cowbell though.
I gave the
Ryan's been getting
cowbell
off
for the first
cowbell
one.
thing. I don't know why. I had to get my own cowbell out and do it.
You
Yeah.
can get it.
Yeah. All right.
Yeah,
I'm
Scott,
sorry. I
we
was just gloating so
downplay
much. I
collusion.
blew by what the statistic was and why it matters. Go ahead, Cris. Fire away.
Yeah. So these are homes under construction, both single family and multifamily. They are still higher than last year, so they're still elevated. So I view this as a positive in the short term. There's still a lot of homes to be built in the pipeline, right? So over the next few months, that should continue to support the housing construction industry, and that offsets some of the negative sentiment we've been talking about here. But if you look deeper in the report, right, permits are down and starts are down. So longer term, there's some concern about the strength of the housing market. I don't think that's a surprise given what's going on with rates and expectations for pricing. So yeah, short term, housing is going to continue to support. Longer term, it's going to be not a drag, but less of a positive for economic activity.
Of course, one thing that I've wondered about, because you got a record number of homes under construction,
right?
And they've been delayed, I guess, presumably because of the supply chain issues around building materials and labor issues related to the pandemic.
Both, yeah.
And so and by the way, in the Philly Fed survey, correct me if I'm wrong, Ryan, one positive thing was supplier deliveries are improving here very rapidly. So it feels like the pressure is coming off the supply chains pretty quite fast. So if that's the case, then you would expect these homes to go to completion. And it's really completion that matters most for output, GDP, and jobs, right? Because you're working on them. The starts and the permits, that's the future down the road, but these are here and now over the next few months, at least over the next 6, 9, 12 months. Do you know, presumably builders could stop building those homes, right? They could kind of put them in deep freeze and say, I'm just not going to go to completion because I don't know if I can sell it at the price I want it, I think is reasonable on the other side of this.
Yeah.
Right? They could do that.
They do that with foundations from time to time, right? They pour the foundation and they stop for whatever reason. Once the house is underway, though,
they're not going to do that. You don't think?
If they've already put up the frame, insulation, right? Then it's harder to mothball that.
And they got money tied up, right? They're financing it in some way.
Yeah. So
you think they'll complete it no matter? Well, it'd have to be pretty bad for them not to complete it.
I think so. As long as they've poured if they haven't poured the foundation yet, then they could, or even if they have poured the foundation, they could stop at that point, cover it up and just wait. But
is there data on that? Do we know where in the pipeline those homes are? Can we figure that out? I mean, that'd be good to know. I mean,
I think there's some private sources.
There might be. Yeah, that'd be really good to know. Because that's really key to the near term here, which is, important. Okay. All right.
There's a big risk of that though, right? There's still.
Yeah, you're right. Prices are still up. They're discounting, but they can make a good return on their investment, I think.
Yeah. I think later on though, I think you're right. If things soften here, if demand falls off and they're in the middle of the permitting process, let's say, then they might pull back from there.
Yeah. Okay. All right, we're going to move forward. I'm going to skip mine just because for sake of time, because we're getting close to time here. Let's talk about recession odds. And let me begin with you, Ryan. What are your probability of recession for the next year, next 2 years, and has that changed from last week?
Hasn't changed. It's still 65%.
For both 1 year ahead and 2 year ahead. Here's the thing I want to ask you. How in the world could this recession happen if it's going to happen? Isn't it going to happen? Feels like it's going to happen soon, isn't it?
Yeah, next year.
Even like next 6 months. It doesn't feel like.
I agree with you.
Right?
I mean, if we get through early next year, then we're going to avoid it. But if there's going to be a recession, it's going to be soon. It's going to be short, but it just seems like everything's pointing towards a recession on the horizon.
Cris, you don't see the excess savings providing some lifeline here and pushing things out. It
hasn't really come down that much though. I mean, the last few months, I would have thought we've got high gasoline prices. You'd see that excess savings be worked down more.
No, but what he's saying is that
that's a buffer.
There.
Yeah,
it's a buffer. Yeah,
and that's why it pushes off recession.
It could.
Point is, it could be worked down, delaying things if job growth were to stop or something, consumers could still carry on for a little while and delay you really entering the recession because of the excess savings.
Yeah, well, that gets back to the argument: do they treat it like cash or wealth?
Right.
So,
No, it does.
right. Yeah.
So Ryan,
And then Scott's leverage point, right? If they build up the balances today, then the trouble may actually reveal itself next year.
Some of it is not cash excess savings. It's that they increase their borrowing and get themselves in trouble by mid to late next year.
True.
Oh no, I think there's plenty of lifelines for the economy. I just think at the end of the day, it's going to come down to inflation and what the Fed does, and they could face Hobson's choice of, rather do they push us into a recession now or wait longer and have to push us into a deeper recession? And I think if you ask Powell and twist his arm, he would say, I'll take a short recession now to break inflation.
I think that's a great point. It's about inflation here and now. And if it doesn't come in, he's going to keep pressing harder and harder on the brakes, and then the economy is going to break.
But then again, the Fed moves operate with long and variable lags. So how quickly can he bring us into
that's what people say, but it feels like it's working awfully fast.
Yeah, I think that time horizon is shortened.
Yeah, the housing market's caving. I mean, demand is caving. Existing home sales, 5.1 million units in June. It was 6.5, I think, right? Start of the year. And it's falling fast here. Anyway, okay. What one statistic are you focused on when you say 65% probability? Just give us one statistic you're looking at.
I don't want to steal Chris's, but it's jobless claims.
Okay.
So the trend, not week to week because they're very volatile, but the 4-week moving average in initial jobless claims. So they are pretty telling.
Yeah, but they're 250. They've moved up to where you'd want them to be, right? If you were the Fed.
No, 250 is roughly the average that you see before recessions. Now that 250 isn't the line in the sand. Actually, one number I was going to use is 275. That's the break-even level of jobless claims right now, which would be consistent with no monthly job growth. So we got a little bit of a buffer. But if we get up to 270, 275, then we got a problem.
So we go north of 275, no job growth. We're going negative, and that's probably we're going in.
Yep.
Yeah. All right. Okay. Scott, do you have a probability of recession in mind? I haven't asked. You've not been on before, so I've not asked. But do you have?
I'm sort of struggling to come up with one. I think I'm probably a little more optimistic than Ryan is, and I struggle.
That's not hard. It's not hard to be more optimistic.
But I struggle with the timing. I'm really struggling whether to put it into the next year or the second year out, because I don't think it's going to happen this year. I do believe the consumer buffer is too much. But I'm not sure if it can happen as soon as the first half of next year.
What's your probability though? Over the next year, do you have one or not? It's okay.
Well, I'm almost talking myself through to try and get to it. I'd say probably a little under half, maybe 45%.
Okay.
In the next year, and then maybe a little over half, maybe 55.
Yeah.
In 2 years, because I am more worried about that sort of 12 to probably 18 month out horizon.
Right. Is there one statistic you kind of focus on, look at, trying to gauge recession risks?
No, I don't know that I have a single statistic I'd go to at this point.
Okay. All right. Cris, where are you?
Unchanged from last week, 50% in the next year, 65% chance in the next 2 years.
Right. Okay. And
there's only one statistic you need. It's the yield curve.
The yield curve.
Yeah.
It's the 10
how are you not higher? It's
once I'm waiting for the 10-year 3-month yield curve to invert. Once that goes, then I'll up my odds.
Yeah.
Well, the difference between the 10-2 was the largest since the early 2000s.
Yeah, and
it's so narrow though. It's only 15, 20 basis points, 0.15, 0.2 percentage points, right? I mean, it's not that big. It's been 2 weeks now, roughly.
I think it's going on 3, right?
I don't think so. I think it's going to be 2 weeks today, I believe. inverted, right, Ryan?
I thought it was around the.
I'm just
4th of
reading
July.
Ryan's.
No,
You don't read
it's roughly
Ryan
2 weeks. Yeah.
Work every day. He sends out a really cool missive every day. It's better than a missive. It's a.
You can say it's a missive.
It can be a missive. Okay, it's a missive, and he at the end he does talk about the 10-year, 2-year spread. And he says 13 trading days. I think today you're going to write 14.
Oh, trading days. All right.
14
trading
trading
days,
days.
Yeah.
Oh, sorry. Yeah.
I was putting it in the weekend.
But that is about 3 weeks, right?
Yeah.
Because you have 5 trading days in a week.
Yeah.
Oh, wait. Oh, yeah, you're right.
Yeah.
Exactly. I was thinking 2 weeks. Yeah, right. It is almost three weeks on trading days. Yeah, you're right. Sorry, Chris.
Okay. It's okay.
What was
Where
my
are you at?
recession
This
odds.
is the big reveal.
Oh yeah.
Mhm.
So I had been at 40% 1 year recession odds and 55% 2-year recession odds, and I'm now going up to 45% 1 year, 55 2 years. So I'm exactly with
Yeah, you're with
Scott, I
Scott.
think.
Yeah.
Yeah, and I'm looking at the 10-year, 2-year, and that's why my recession odds have gone up. If that doesn't right itself here in the next week or two, then I'd have to go up to at least 50%. And I do agree the 10-year 3-month would be real ratification of what the 10-2-year is saying. I do look at the UI claims, and I thought 275 to 300 would be problematic. I mentioned the Philly Fed down 20. I think that would be an issue. The Conference Board survey down 20 points over a 3-month period. That would be quite bothersome. We're awfully close, to going recession, but that's kind of sort of where we've been, right? That we're going to get right on the precipice and pull back before we actually fall over. And while you're on the precipice, it feels pretty uncomfortable, like you are going to fall over, but that's completely understandable. That's what you would expect. So this is to script so far. I will say, I agree with you, Chris, that if anything else goes wrong, we're done. And the probability that something can go wrong here is not inconsequential. So, risks are awfully high. So I agree with you. But the consumer's the firewall, got to hang tough. And you're wrong about debt. That's all I got to say on that issue, at least so far. Any other pearls of wisdom before we move on, before we call it a podcast? No? Okay. We're going to call it a podcast. And this was a long one. Come back next week. We've got Princeton Professor Alan Blinder. That should be a good conversation. But thank you. Have a good weekend. Talk to you soon. Take care now.